Hello, and welcome to another stock analysis on Stock Market Palantir. Don't forget to subscribe and drop your comments. Now, let's go hear our analysts.
Welcome to the Stock Market Palantir. Today we are going to talk about RIVN. So RIVN is right now probably the most compelling and I'd argue the most confounding story in the entire high-growth EV space. As of, early December 2025, we've seen this incredibly volatile trading. The stock has just locked in this tight psychological band right between about $17.95 and $18.06. This price action, and this is important, is part of a complex recovery path from its 52-week lows, which were down near $10. We saw that spectacular, plus 23% surge right after the November earnings beat, only to watch it retrace sharply by 7% in the first week of December.
And that's really the core question we face today, isn't it? The one that's splitting the market. Is this a real transition? Is RIVN successfully becoming a legitimate, high-multiple technology platform? Or is what we're seeing just, clever financial engineering that's masking a fundamental money-losing manufacturing operation?
Exactly. That valuation duality, as you put it, is the friction point. My position is that the institutional accumulation we're seeing, combined with the successful software monetization they've achieved through that Volkswagen joint venture, the VW JV, that it fundamentally supports a higher, sustainable valuation floor. I believe the market is finally starting to correctly re-rate this stock.
And I just come at it from a completely different perspective. I think that entire attempt to assign a tech multiple is inherently fragile. I see persistent, deep-seated manufacturing losses in the core vehicle business, and I see this inevitable, high-risk factor of future equity dilution just looming over shareholders. So my argument is that the bull case is really built on a foundation of sand, supported by what might be temporary or, let's say, strategically purchased revenue streams.
I see why you think that, but let's look at the facts from Q3. The Q3 report was, it was nothing short of a paradigm shift. RIVN reported a positive gross profit of $24 million, a figure that absolutely shattered the consensus expectation, which was for a loss of nearly $39 million. Now that swing, that was driven entirely by $154 million in high-margin revenue from the VW JV and related software services. This proves the successful monetization of their intellectual property. When we look at a typical, capital-intensive manufacturer, they might trade at maybe one-time sales, but if RIVN is successfully transitioning to a technology licensor, that multiple expands dramatically, potentially to 5 or even 10 times sales. This is about asset utilization, not just bending metal.
And furthermore, institutional behavior validates this thesis. Dark pool data consistently shows off-exchange volume above 40%. Now, for our listeners, dark pools are just private exchanges used by large players to trade massive blocks of shares without moving the public market price. This consistent, high off-exchange volume indicates professional accumulation, creating what we see as a shadow floor, particularly near that crucial $17 support level. We call it the liquidity wall. Smart money isn't buying into a failing enterprise. They are positioning for this decisive pivot.
Well, that's a compelling narrative, but I would frame that Q3 profit very differently. The $24 million gross profit, while it is positive, is structurally deceptive, and frankly, it feels financially engineered. Let's look behind the curtain for a second. If you strip out that JV revenue, the core automotive operations business, the physical act of building and selling R1 trucks, still generated a massive operating loss of $130 million for the quarter. To put that simply, the underlying manufacturing unit economics remain heavily capital intensive and unprofitable. You can't just wish that away with a smart licensing deal. Operational challenges persist. Look at the fact that the stock immediately retraced in December right after they reduced the full-year delivery forecast, lowering the midpoint by 500 units. A growth company lowering its ceiling is almost always punished severely by the market because it signals a scaling problem.
Right.
And this leads to the critical risk. Future growth relies on massive expansion, specifically the R2 platform ramp. But this comes at a steep financial price. RIVN is actively preparing for major equity dilution, by increasing authorized shares. That's Proposal 5 on their upcoming ballot. This is preparatory for raising growth capital, and that action guarantees future dilution that will act as a significant structural headwind to share price appreciation, regardless of any short-term institutional buying.
Okay, let's focus on that Q3 profit composition then, because this is really the core tension. I acknowledge the $130 million auto loss. That is the COGS problem, the expensive process of stamping metal, integrating supply chains, all of it. It's hard to make money on large premium vehicles right now, especially as you scale. But my point is that the $154 million in high-margin JV revenue is a permanent strategic advantage because it completely changes the trajectory. It provides a vital cash bridge. This high-margin cash flow buys them crucial time to streamline the factory and fix that COGS problem, and time to launch R2 at scale with inherently better margins. The firm is now generating substantial, scalable cash flow from an intellectual asset, not just a physical one. This strategic flexibility justifies the re-rating.
So, how much time do you think they bought themselves, and what metrics need to improve on the COGS side to satisfy your skepticism?
That's a good challenge. They probably brought themselves, maybe 18 to 24 months of stable cash flow without having to take on more immediate debt, which is valuable, I'll grant you that. But to satisfy my skepticism, we need to see that $130 million operational loss shrink organically to less than $50 million, and we need clear guidance on how long this VW JV revenue is guaranteed to flow. If the agreement is front-loaded, then the strategic advantage just evaporates pretty quickly. I'm sorry, but I just don't buy that the market should fully re-rate the stock based on breathing room purchased by a single deal. The stock is being valued on a high multiple tech premise, while the foundational business is still heavily cash negative. We are essentially valuing the company based on its IP, while the physical product that generated that IP is still losing money.
This just exposes the stock to huge risk if the VW revenue stream tapers or, crucially, if the R2 ramp costs spike.
Deceptive to whom, though? Isn't it just standard practice to report all GAAP revenue? Are you suggesting this JV cash flow is some one-time event that disappears next year? The deal structure suggests this is ongoing IP licensing and shared platform costs over the lifetime of their Gen 2 platforms. That changes the risk profile completely. The market already anticipated that $130 million loss. What it didn't anticipate was the successful monetization.
I accept the ongoing nature of the JV, but the market shouldn't ignore the policy risks either. We haven't even factored in the removal of regulatory credit sales from the forecast and the potential elimination or, further restriction of the $7,500 federal EV tax credit. That directly impacts demand for their luxury-priced vehicles. These aren't just minor market headwinds. They are direct hits to the demand elasticity of their core money-losing business. We need a real quantitative understanding of how much demand just evaporates if that tax credit disappears.
Okay, I accept the policy risks are real, but I believe the market has largely priced in the worst-case policy scenario already. That's why we saw the dip in the stock after that guidance change. Let's go back to the institutional behavior, because the microstructure data suggests the smart money is already pricing in the success of this strategic pivot. If the stock were truly doomed by operational weakness and policy headwinds, institutions would be fleeing, not accumulating.
Okay.
I mean, we keep hearing about the fear of dilution, but why is this not reflected in the immediate market structure? The institutional liquidity wall at $17, where roughly 18 million shares transacted off exchange, is not a sign of fear. It signals strong underlying buying pressure being absorbed by market makers. They are using the dark pools to build large positions without telegraphing their intent to the retail market. Moreover, the high off-exchange short volume ratio, often 45% or higher, paradoxically indicates that market makers are stepping in to supply shares to meet fierce institutional buying demand. This is sophisticated money actively hedging and accumulating, providing a firm, defended floor. The smart money believes the stock is undervalued right here.
That's a compelling point on the microstructure and the short-term defense of $17. I'll give you that. But have you fully weighed the corporate action that increased authorized share count via Proposal 5 as the significantly greater long-term systemic risk? You clarified that RIVN is not consolidating shares to survive. They are expanding the share count to fuel massive multi-billion-dollar growth.
This is the unavoidable cost of growth, but it guarantees major dilution for existing holders. We're talking about preparing to issue new equity warrants or convertible notes to secure funding for the R2 factory and to satisfy the capital requirements for the $5.8 billion deal with Volkswagen. The smart money that's accumulating today can jump ship fast. Can their short-term positioning actually fight off the guaranteed structural headwind of necessary future dilution from these capital raises?
Which, by the way, are certain to happen in the next 12 to 24 months. The market has to eventually discount the stock for this.
The discount might be baked in already, but the potential future value of the software platform, that 5 to 10 times multiple, it outweighs the short-term dilution costs, provided they execute. Dilution is acceptable if the subsequent growth rate in revenue and margin outpaces the increase in the share count. I mean, we're talking about trading perhaps 20% future dilution for the potential of 500% appreciation if the software pivot is successful. The institutional accumulation at 17 is positioning for that higher target, signaling that they see the dilution as a necessary and frankly small cost for a much larger prize.
But the risk remains. If the market is valuing the company at 5 times sales on the promise of software, that valuation is only as stable as the software execution.
And that brings us to the immediate, high-stakes catalyst, Autonomy Day on December 11th. This event is the fulcrum. It's what can trigger the definitive re-rating. A successful announcement of universal hands-free driving, leveraging their multi-sensor fusion strategy, and this end-to-end AI pivot could shock the market and definitively unlock that $20 resistance level. And this is where the microstructure meets raw speculation. The combination of institutional positioning near 17 and the intense retail YOLO bullishness on the options chain creates the powerful potential for a short-term volatility event, specifically a gamma squeeze.
Okay, before we go further on the options flow, quickly clarify for us what a gamma squeeze actually means in practice for a stock like RIVN. That term gets thrown around a lot and can be confusing.
Excellent point. So a gamma squeeze happens when massive option buying, particularly of calls, forces market makers who have to hedge their positions to buy the underlying stock in large quantities to remain delta neutral. This buying pressure then pushes the stock price up further, creating a powerful, self-reinforcing upward spiral. Institutions are effectively locking in shares cheaply off exchange and buying cheap upside exposure through options, signaling their expectation of major upward volatility specifically around this December 11th event.
I'm just not convinced by that line of reasoning because it places way too much emphasis on speculative gamma squeezes and ignores the execution risk inherent in the announcement itself. Retail views RIVN as a binary outcome. It's either bankrupt or a 10x, which drives that option volume. But that mindset doesn't guarantee a successful product rollout. We have to address the Gen 1 problem. If RIVN announces that the new UHF features are exclusive to the R2 platform because they require the updated compute chips, they risk alienating their most loyal, highest-paying early R1 adopters. That kind of execution failure could temper market excitement dramatically and cause that gamma squeeze to fizzle out fast. And what about monetization? Is this a $10,000 upfront option, a $100 a month subscription?
Ambiguity on pricing could dampen the stock's reaction, even if the tech demo is impressive, preventing that short-term volatility from breaking $20 permanently. The tech has to be flawless and immediately profitable to justify the market's elevated expectations.
Ultimately, what we are seeing is a battle between two highly significant but opposing financial realities. The immediate operational costs of being a manufacturer, that persistent $130 million quarterly auto loss, and the massive, verified potential value of their intellectual property, evidenced by the VW JV and the resulting strategic cash flow. The institutional data shows accumulation and a firm floor at $17, confirming that the death spiral narrative is over, but the stock remains in this tight band.
I agree. The transition is critical and fraught with risk. RIVN is undergoing a complex metamorphosis, moving from a capital-intensive manufacturer toward a potential software platform. But the price of that transition is immense future dilution and the absolute necessity of flawless execution on both the manufacturing ramp and the software vision they present on December 11th. The market has to decide if the short-term gains from the JV and accumulation outweigh the long-term structural cost of growth and the immediate operational deficits.
Thank you very much for hearing us. Let us know in the comments what is your opinion and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.